to Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors, and today we have a very special guest for you. We're talking to Bryce Holdaway, who is one half of the host of the Property Couch property investing podcast. He's of course been featured on television on the Location show. He's a published author and industry commentator when it comes to everything property investing. We have a chat to Bryce about why property investors have become scapegoats in the political debate around rental affordability. And of course, it'd be remiss of me not to use the opportunity in chatting to Bryce to get his advice and insights into how to be a successful property investor today. It's an awesome interview with Bryce, which I'm sure you're going to get a lot out of it. Here's Bryce. Bryce Holdaway, thanks for joining me on Geared for Growth.
Oh, thanks for having me, Mike.
We were talking off air about you spending years trying to get Chris Voss on the show, never split the difference. I think I probably tried for a couple of years to get yourself, so it's good to finally get you on.
Oh, thanks for that, mate. I appreciate the persistence, and I can't give you any logical reason why not, other than I think just getting schedules lined up. But mate, it's great to have a chat with you.
You're a busy man. Obviously, people would have seen you on the telly. We won't talk about the new version of that show. That's another episode. But of course, as the host of the Property Couch, you're in a lot of people's earballs on a weekly basis talking about property. And the focus of today's episode, we want to talk about kind of the political state of the investor in the dialogue. So the media, I think, has been sharing all of these notions about the affordability crisis, the rental affordability crisis, and talking about supply, but very little discussion about the role that landlords have in the rental affordability space. Why do you think landlords haven't really been recognised for what they're doing there?
I think because most of the narrative that comes out is that they're getting wealthy by being leeches off the tax system, and I think that is a bit of an unfair narrative, but it is the dominant one because, as you know, there was a failed attempt by the prior Labor government campaign to scrap negative gearing on established and only for brand new. And
2 attempts, I guess.
Two attempts. And then even if you go back, like it's been a decades in the making, mate. It's like back in 2014, they changed amount of lending that banks could do for investors. And then there's been changes to reforms for property management and what landlords are going to provide. So there's been this decade-long run-up to actually provide instability and disincentives for property investors. And little bit of narrative around the fact that unlike a lot of places around the world, in Australia it's quite unique, where a very large percentage of the rental stock is provided by private landlords, i.e. mum and dad investors. And I think it's easy to just read the headlines, but once you look under the bonnet, you realise that most people who are trying to create some form of financial freedom, wealth, lifestyle by design, whatever you want to call it, using property, they're doing it in a way to self-fund a retirement, which is actually good for the Australian taxation system so that they won't be relying on the pension. But if they are portrayed as greedy fat cats leeching off the tax system, that won't help. I'd rather the narrative be small business owner, because if you think about your small business owner who is a cafe down the road or whatever the small business is, they're usually taking a risk, probably leveraging against their own home, probably delayed gratification for some reward in the future. Property investors are generally the same as that.
I think that's a really good parallel to draw. Now, I don't know the exact stats of the percentage of businesses that are small businesses. I think it's probably around about 60%, but the percentage of people that provide rental accommodation as mum and dad investors, or whatever the modern term we need to update it to is, it's about 91%, right? But yet small businesses are kind of like the darling of politicians. You know, we've got to look after small business owners because they're important for the economy. But for property investors, as you say, they're kind of leeches on the tax system. One thing that I sort of shake my head at is they talk about the negative gearing loophole. Now, as far as I'm aware, negative gearing came in at about 1936. How many loopholes do you know that are nearly 90 years old?
Yeah, not a lot, but you know, yeah, interesting, isn't it? How they play it. That uh, for the majority of, like, if you think about it, you talked about 91%. So there's about 2.2 million property investors in this country, and 73% of them stop at one.
Yep.
So let's call that 3 out of 4. 3 out of 4 people who take the risk, take the swing, try and do something for their future, go against the tide, not be able to talk to many people about it. They take all this risk. 3 out of 4 stop at one. Now, you know, if someone buys one investment property, Mike, and they hold it for long enough, and they combine it with their super, they'll have some choices that are pretty significant if they bought the right property. But generally speaking, you're not going to retire off one property. You need, in our view, 2 or 3, plus your family home, plus combined with your super, to be able to keep the capital in place so that you can just retire off the rents as a passive income. But most people stop at one. So the fact that there are some outliers, there are some people that have 100 properties. There are some people that have 10, 20 properties. In my experience, the more sophisticated the investor aspires to be, the more likely they are to jump into commercial or industrial real estate as opposed to residential real estate. So if it's 73% stop at one, and to your point, 91% stop at 1 or 2, the reality is that the property investor isn't a greedy fat cat that's leeching off the tax system. It's generally probably someone that you meet at the schoolyard gate, or someone that you bump into at the water cooler at work, or someone that you meet having a drink on a Friday. They're probably just like you and me, who are deciding, hey, I'm going to have a go. And most of the time, they won't talk about it because in this country, there's a bit of tall poppy going on. So unless we know there's an in that someone's interested in the space, we don't talk about it. The narrative is misleading. But if you do draw the parallel to the small business owner, and when a small business owner has extra costs incurred on them, they generally inflate their prices. That is the same with property investors. They've passed on a very disproportionate amount of the expenses that they've received in increased mortgage costs and increased compliance costs to the tenant. But clearly we've got a political conversation around rents need to be looked at, and property investors need to be taken out of the market, because then more people will be able to get property. And I just think it's a misplaced narrative.
A very good point about disproportionately passing on those costs as well. Unfortunately, I threw it on the floor of the studio, but I've got a graph showing the disparity between the costs borne by landlords and those by tenants. And of course, we know that tenants have suffered. The pace of change in rents is too quick, right? Like, it's too quick to really comfortably be a tenant in that ecosystem. But you model it out over 20 years, as Peter Kalizos has done, it's underpaced inflation, right? But the landlords have seen that increase at the same pace as well. It's just there's more noise on the tenants. And I'm wondering, if we try and go for another parallel, they talk about being a US president, you've got to have, the Rifle Association behind you. You've got to have the Christian vote. We're talking over $2 million investors as 10% of the population. Isn't there enough there that you think politicians will look towards to maybe kind of, I guess, do a little bit of a signal to say you're just aspirational people that are trying to invest in your future?
Yeah, you'd like to think that, wouldn't you? But it's property investors are easy targets. Politicians have seen property investors as ATMs for the state for some time, and it's largely one of those places where the majority of the people aren't investing in property. So if they take after that small group, it has very little political backlash for them. So, Ben, who I co-host the Property Couch with, he heads up, well, he's the chair of the Property Investors Council of Australia, and he's recently got himself a seat at the table to have a conversation around the rental scenario and the talk of rental freeze and what that looks like. But I've got to promise you, mate, he had to spend an extraordinary amount of time campaigning just to be allowed to be in the room to be the voice of the people, or voice to represent the people who some of these changes will impact the most. So I think it's pretty politically easy to have a swing at property investors, mate.
Yeah, he had to campaign to be one of very few people that are the voice of 2.2 million property investors. It seems crazy. And I was actually going to ask you about Ben, because I went to the Property Investors Council of Australia website recently and looked at his video about some of the policies that the Greens have been tabling about rental freezes. Now, we did have the National Cabinet meeting recently where Albo has basically said, look, we're not going to be looking at rental freezes. Do you think the political debate is turning a corner? Are we getting there, do you think? Are you a glass half full, or the glass is empty, we've smashed it and they're not making any more glasses?
Yeah, I'd like to think it was the glass half full. It just feels like when you dodge one bullet, you got to be looking out for the next one. And I think the sooner we can, as we're having this conversation, the quicker we can change the narrative around how property investors are perceived in the marketplace, the more we can get seats at the table to have these conversations, I think the better. But at no point do we get comfortable that the job is done, because it just seems like everyone's trying to have a piece of the poor old property investor. And whilst the perception remains greedy fat cats, it will continue to be an easy target.
All right, I want to try and change direction on you, just so that this isn't some property investor biased kind of love-in. The difference between say investing in Coca-Cola shares and investing in a home is that someone can't live in Coca-Cola shares. So kind of what happens to the maintenance of that business, whether they go up or down, doesn't seem to be as emotive as a human being occupying a premises. Do you think that there is some notion that people shouldn't be investing in housing because there's somebody that's in there that kind of suffers from the maintenance and ownership of what is just supposedly an appreciating asset?
So sorry, is the question, should we not be encouraging property investors? Is that?
I think so. Do we make a statement to say, look, houses aren't an investment asset; they're just some sort of universal right that the government is able to fund somehow?
Yeah, well, that last bit's important, because the government hasn't done a very good job at any time over history to be providers of residential accommodation for people. So let's answer the question by saying, well, what if we actually did take private landlords out of the market? It would be a diabolical nightmare for tenants and for providers of housing in this country, because I worked for the Queensland government during the GFC, when Kevin Rudd was spending money trying to get us out of the economic uncertainty at the time, and governments we had large pools of cash that we were giving to developers to try and build more housing, and I can tell you it was grossly inefficient. I can tell you that there was a lot of money wasted, and I can tell you that people were just looking for arbitrage opportunities to make a quid at the expense of the ultimate outcome, which was public housing. So governments do not do it well. So if you were, if the rental freeze was to happen, investors would leave the market in droves. And so what would happen is the poor old tenant, who the legislation is intended to protect, would be worse off by a country mile. So if you have a look in overseas markets, when you mess with the market forces of government interference in the market forces of the property market, have diabolical outcomes. So I actually think, if we've talked at the top of the show about this being a decade-long campaign of disincentives or uncertainty being provided to property investors, I think for us to fix the affordability issue, to fix the rental crisis, we need to create incentives. And I understand that people say, sure, if you want to, don't go to the barber and ask if you need a haircut, because they're just going to say yes. So I'm a property investor, right? But if we provide more incentives for property investors to enter the market, therefore there will be more opportunities for supply. and therefore we can then create opportunities where we can release more supply, which will house more people. I see it as being a benefit for the tenant rather than the alleged benefit to the tenant if the property investors were to leave the market. If they sell, another owner-occupier might buy. It means the pool shrinks even further before we even talk about systemically the challenges that await if you do that.
Mm. And talking about Queensland, with the legislated land tax changes, I sent some data to Ben. I think he plugged it on your show a little while ago, where we saw a huge drop in investor activity in Queensland for that 98-day period that the legislation change was actually ratified, right? So I think that's an insight into what happens if you put restrictive measures on investors. The pool actually shrinks, and the policy that they're putting to try and help rental affordability, they're actually kind of exacerbating it. I want to ask you about the alternative to property investors. Here I am still trying to be, speaker one for the negative. I'm probably doing a bad job because I don't really believe in it, but it seems like the government wants to encourage these build to rent and these kind of institutional landlords like super funds that are building community housing and they're offering tax breaks and those sorts of things. Why do you think they're wanting big business to be supplying rental accommodation rather than mum and dad investors or people like you and me? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Well, it's a great question. Well, I guess because of the multiplier effect of creating jobs, right? So Clearly, big businesses, developers, the multiplier effect of a brand new property, you know this better than most, Mike, but the multiplier effect of a brand new property is so much more significant than transacting an established property, right? So the multiplier effect of all these build to rent at large scale, there's the builders and the crane operators and the sparkies and the retailers who have to stock. So it's great, right? But that's probably part of the conversation for us is, okay, well, if the poor old private landlord is being painted as a greedy fat cat, and they generally statistically only buy one, maybe two, versus these big, large corporates or super funds that are getting significant tax deductions and incentives to try and get them to enter the market. There is an imbalance around that narrative also, which doesn't really make it to the public space. But if we're trying to supply, so I don't think it's an or, I just think it's an and. Let's incentivize private landlords, and let's continue to incentivize the big end of town to provide accommodation, because if we do have a rental crisis, if you think about where the rental crisis has come from, it's 20, 30 people lining up trying to have a swing for one property and just fighting over each other to try and get it. If there's more supply, that is a good thing for the poor old tenant. I don't believe in slumlords. I don't believe in marginalising people. I don't believe in seeing people under an enormous anxiety just to find a roof over their head. So if they could both contribute to being part of the solution, I'm all for it.
What do you think is sort of the mindset of investors at the moment when they're going through all of these sort of state-by-state conversations and hurdles to jump? The Victoria, you had the minimum standards. You've got some land tax changes. We had the land tax changes in Queensland. We talked about national rental freezes. I mean, you deal with property investors all the day and all the time, and I presume they're making these decisions based on 5, 10, 30-year time horizons, but there's all this tinkering around the margin. Do you think that's contributed to the increase in landlords selling, which has been a huge thing in the last little while?
Yeah, I do. I think it does. For what we're trying to do is we're trying to get investors to lift their eyes and play the decades game. But for a lot of people who are, we're experiencing the tightest, the steepest interest rate tightening cycle that we've experienced. And then on the backdrop of a decade of disincentives or uncertainty in the property market. So it kind of makes sense when someone goes, all right, well, I looked at Victoria and I'm going to get slugged with a bit of extra land tax and I've got a bunch of compliance costs. Or if I went up to Queensland, I had to dance with the pay land tax across the entire country devil. Or I go to New South Wales and think it's pretty bloody expensive to buy in there anyway to try and be a part of that centre. And then we go over to the West and have a look in South Australia or Western Australia. So it becomes a challenging space for people when there's so much market volatility as an investor. You don't want sort of regulatory volatility. You want certainty in the space so that you can let the market forces do their thing. So I do understand why people want to not invest. They want to divest or not invest at all. But I think if you can remind yourself of the fact that Australia has a superpower, and that is we're a sovereign country with political, financial stability. Our climate and our lifestyle is first class. We have our own food bowl here, and we're largely sheltered from some of the goings on in other parts of the country. I mean, when you watch our news cycle, it's pretty insular. We only hear maybe about Australia and New Zealand, whereas if you go and watch the news cycle in London, you hear all about Europe and all through Asia, and it's just a normal part of their world that they see all these other things, right? So we've got this wonderful tyranny of distance that works in our favour. So if so many people want to move here, and we unusually base ourselves around the urban fringe of the coastal lines of the country, it could arguably be one of the best decades to own residential real estate. Because if in 2030 you look back and you see all these people that were coming here, and we probably don't have the infrastructure that's expanding at a fast enough pace, and if you're able to put your name on a title during that decade, and you've got all these people coming from the other side of the world sort of desperate to do a little selfie at the front of the property that they've just purchased to send it back home to tell the family that, see, this is the reason I moved to this country. And they work hard and they bring the migrant mindset and all those sorts of things. I just see it as a real opportunity for people who can see the bigger picture of going on here. Because I do get that some of the disincentives at the localized level, as you sort of think in a monthly, yearly cycle, they can be a bit intimidating. But you only need to look back over 30 years to see the performance of property trended up. But then you see all the little dots along the way that said GST was introduced, and we had the Asian flu issue, then we had the pandemic, and then we had this recession, and all of these things that happened along the journey, they were all in their isolation reasons that you shouldn't have done something. Then as you look back in the rear vision mirror, you go, I'm glad I put my name on a title and just let time do all the work for me.
That's a good point, and it brings to mind those sort of famous Simon Presley graphs that he likes to do about all the shit hitting the fan style events in history, and then the property market just sort of chips along. Is that sort of the best advice you have for investors that are a little bit panicky about the environment, is to take that sort of long-term view?
Yeah, 100%. So we interviewed this guy on the podcast, Mike, and it was a really good story. He built a portfolio of property, 5.54 million, in his 50s, right?
Wow.
And he tells this story that he bought this first property for $212,000 in Ryde in Sydney. And only 3, 4, 5 years later, it was a short period of time, sold it for $550,000. Wow. Now, if you that's pretty good, right? In a small period of time, 212 doubled is 424, and he sold it for 500 odd. So he thought, wow, this is pretty good, 550 over that. But then recently had a look. So that was back in the 90s. Recently had a look, and it turned over again for 1.7 million.
Yeah, right.
So imagine if you had held it from 212 to 1.7 million and still owned it.
Yeah.
The rent would be significant. It would be providing you well and truly a passive income on that property. You wouldn't have had to pay any capital gains tax because you still wouldn't have sold it. And it just goes to show that it's a decades game. Like if you track a property that you purchased it over, say you could see it over 30 years, and we've actually done this a number of occasions, you see the actual dollar growth in the first decade. Then you compare it to the, not percentage, the dollar growth. The dollar growth in the first decade. Then you compare it to the dollar growth in the second decade. and then you compare it to the dollar growth in the third decade, and that third decade is it is actually mind blowing. That when you did it in the beginning, in the first, if you could go back to the time you purchased it, you'd go, there is no way that is ever going to happen. That number looks outrageous. And then when you come back, you go, gee whiz, glad I held on to it because that number is outrageous and it's in my name. So it's just one of those things of having faith that every single person who buys investment property, they look in the rear vision mirror and they go, yeah, I can see it went up, but it's not going to do that ever again. Like that, those growth rates are never going to happen again. So it's like, okay, no problem. But for those people who hold the journey, that's where the fruit is.
I think I saw a similar style graphic on a wall in your office in a picture. This might have been quite some time ago. I remember there was some sort of graph charting property over the years. Is that what we're talking about?
Yeah, that's in our foyer. It's the CoreLogic one that tracks it and shows all the events that contribute at the time. But no, it's just I encourage anyone to do it on a property that they own, and then just go backwards and do the 3 decades exercise and just suss it out. The numbers are like 14% of the growth is in the first decade, late 20% is in the middle decade, and mid to late 50s is in, and this is the dollar value, in the third decade. So my philosophy on property is quite simple. Buy the right asset, correctly finance it, hold it for the long term, and have a buffer in place. So that the buffer buys you time, and the time in the market is where you're going to get the benefit from holding the investment properties. And for those people who like instant gratification or stuff to happen quickly, property investing is get rich slow. It can be incredibly boring. And you have to sit on your hands and trust the process for a number of decades. It's like, so I can see why people would chase more exciting property development or cryptocurrencies or share trading, and I can see why that's appealing because there's more immediate results. But for those people that have just played the boring old game of buy a property and hold it for the long term, it's a pretty cool outcome.
I think that's probably what I've learnt in interviewing probably 200 property experts plus, is that the best advice is actually quite boring. Like, can you imagine we're pitching this episode, Bryce, he's been on the telly, he's written books, he's got Australia's biggest podcast. We share his hot tip, and that's to buy well, finance it, and then just calm down and wait. Like, no one's going to listen to that, right? Because we want instant gratification. And that kind of leads me to a question where if you look at, say, Facebook posts around property, and there's quite a few big property forums that people can go on, and it's all like, what do you think about Mildura? What do you think about Bow Desert? What do you think about Mount Gambier? Your job, I suppose, at Empower Wealth is to give people the education and the tools to fundamentally change their financial future. So how do you counter that kind of sugar hit that people are getting from the hot spotting and it's much more exciting to time the market?
It is much more exciting to time the market, but I always just go back to the stats, mate, and in the theme of let's just be as boring as possible. If 73% of all property investors stop at 1 and 1's not enough, most people spend a lot of time on forums and not a lot of time actually doing any action, right? So over the journey, Ben and I have spent a bit of time talking about, well, here's a framework that you need to succeed, and here's another framework that you need, and what about this? Now we just spend all of our time trying to get people to take action because you know better than most, Mike, that unless you actually get in the arena, it doesn't matter. As long as you're directionally correct, and there's a few basics you need to get right, and buying the right asset is really crucial, right? So if you buy the wrong asset and let time do its work, it can work horribly wrong for you. But generally speaking, if you can lower your action threshold and actually step into the arena and be directionally correct, buying, a B or a B property or better, chances are you're going to do pretty well. So for those people who spend a lot of time on forums, I would love to be able to survey them and say, how many of you have actually taken action? Because I would hazard that a lot of them paralysis by analysis, or waiting for X, Y, or Z to happen before they buy. But generally speaking, the people who take action are the ones who enjoy the results. So we build a plan. We have from A to B. We don't treat, a lot of people treat money like they treat maths, right? So, Mike, 2 + 2 = 4, 10 + 10 = 20. No matter where you grew up, no matter what your background is, no matter what your demographic is, the answer is the same for all of us. But with money, it's different. We're all doing different things. You might have a need to do some things that I just don't need to do. Or I just want to free up my time so I can spend more time with my kids. And you might want to build orphanages in India. Like we have different risk profiles. We have different salaries. We have different salary incentives. We have different time horizons. We have different needs. So the sooner that people realize that all I need to do is go, I'm at A, and define where their B is, and then put a plan in place to achieve that. It doesn't really matter what anyone else is doing, because you don't have to find the perfect property.
Yeah.
You just have to find the property that works for your plan so that you can actually do it within the boundaries and the parameters of your risk profile and just get on with it. But it all starts with, the journey of 1,000 miles begins with a single step. They say it begins with a single step for a reason, because unless you take that single step, you get nowhere. And so I spend a disproportionate amount of time now just focusing on people saying, have you actually done something?
Yeah.
Because if you actually haven't done anything, it doesn't matter what you think about on a forum.
Yeah. And it's interesting, you hear so many people say, I'm just going to wait to see what the market does, or when interest rates drop, and wait to see what happens. But then you look at that graph over the long term, and any of those things that happen, you zoom out far enough and it's the tiniest blip, right? And I always think the best time to buy a property was yesterday. But for to round out the conversation, and it would be remiss of me not to sort of get a bit of a download of where your head is at with the world such as it is, with these polished versions of social media people and Instagram, where everyone's far happier than they are in real life. With all this new information around hotspotting and data and prop tech and AI and all this sort of stuff. What do you think is the most important thing for people to take out of listening to this episode that are wanting to invest in their financial future?
I think we've talked about it a fair bit. I'd say play the decades game, not the years and months game. I would say that remind yourself that property is no different to apples and oranges. If I have more people who want the apples than I have available, the price of the apples probably going to go up. And if I have less people who want the apples than I have available, the price is probably going to go down. So that simple analogy will serve you with property. So you've got all these gravity centres. So where's the gravity centre? It was the CBDs prior to COVID, but now those gravity centres have moved. So the Melbourne CBD will now have to split up with Geelong and Ballarat and Bendigo and Sunshine. And so there'll be these other satellites that build, which become gravity centres. So, but knowing that people are going to be there, that's how you know where the apples with more demand are going to be than the apples with less demand. So if you actually just keep in mind that property, despite its emotional and practical application for most people, is still just a game of finding something where demand exceeds supply. So being clear on the type of property that you can buy, and if you play the decades game, not the sort of headlines game, that'll serve you. And my last one is probably Evan Lucas wrote this this book. It was called, I can't remember, something money. It's a money mindset one. I should have it off the top of my head. But there was this beautiful graph in it, and I love it. I spoke to him about it on our podcast. And if you go and get a textbook growth graph, and you say you buy the property and on average it does 7%, you do the graph, and it's this beautiful exponential looking graph, right? You think, oh, I can buy an investment property with that exponential graph. But then you turn the page in his book, and on the second page, he goes, let me tell you what that exponential graph actually looks like. And it's ugly. And it's got a bit of up and a bit of down and a bit of up and a bit of down. But generally speaking, if you held it at the beginning of the graph and you still owned it at the end of the graph, you'd get the same outcome. But it's being able to weather that sort of volatility that comes in between, because, properties that we all own now have come off a little bit from their peaks of just a little bit. So if you have got this beautiful graph in mind, that would put you into lots of stress and lots of anxiety. But if you take a step back and you go, well, I'm not going to sell it. I really only care about its performance next decade, not this decade. Play on. Then you start to realize that that's what the game is. So the quicker someone can realize that property investing isn't that beautiful sort of exponential graph, it's just a bouncy sort of jiggly graph all ending up in the same destination, the more peace you'll have, the more chances you are that you A, will buy an investment property, and B, be one of the small percentage you get to that 2 or 3. Combine it with your super. Sounds like you'll end up with a pretty good lifestyle by design if you do that. But you do have to swim upriver against the tide, against public opinion to be able to do that. Just because statistics tell us that not many people do that.
I love that. Einstein said that if you can't explain something simply, then you don't know it well enough. And I think you've just shown that you know your subject matter intimately. Bryce, I very much appreciate you coming on the show. Thanks for sharing all your wisdom today.
Appreciate it. Thanks for having me, Mike.
Cheers.